Imagine owing the Slovenian government like 125,000 euros in immediate fines.
Yeah.
And all because your software developer accidentally mapped a single line of back-end code to class 4 instead of class 5 in your accounting software.
Oh, yeah, it happens.
Right. Like you didn't steal anything. You didn't lie on your taxes. Your software just fundamentally misunderstood the legal architecture of the country.
Exactly.
So today, we are looking at a highly technical 2026 developer roadmap. And we are going to show you why translating an application into a new language is, well, it's absolute child's play compared to translating a country's rigid tax laws into a database.
It is an entirely different level of complexity, really. I mean, when software crosses a border, it isn't just adopting a new vocabulary. It is adopting a totally new legal reality. It has to enforce, new rules of mathematics, new definitions of what a business even is, and new highly automated ways of talking directly to the government.
Okay, let's unpack this, because our mission for this deep dive is to explore the exact specifications for implementing Slovenian localization in the osFinancials and TurboCASH software ecosystems.
Yeah, it's a massive undertaking.
It really is.
Yeah.
We are going to extract the critical developer codes that make this work. We'll explore the massive compliance differences between a freelancer and a corporate entity, and dissect this mandatory 10-class ledger system that literally acts as a digital pipeline to the state tax authorities.
It's fascinating stuff.
So if you've ever wondered how global software actually adapts to local laws without getting its users fined into oblivion, you are in the right place.
It truly is a masterclass in how a developer has to mirror legal structure within software structure. I mean, before the application can even do the math, it fundamentally has to know the rules of the road.
Yeah, and actually I'm looking at the developer notes here, and it's demanding very specific language codes before we even get to the math.
Right, the ISO codes.
Yeah, so why can't the system just use a generic, I don't know, Slovenian setting in a drop-down menu? Like, why all these strict ISO requirements just to change the text on the screen?
Well, because a generic setting doesn't tell a global database how to handle regional encoding or currency symbols or date formats.
Oh, I see.
Yeah, the developers building this localization, they have to implement the exact standard ISO language codes right into the backend.
Okay, so what are those?
Specifically, they need the 2-letter SL for the broader ISO 639-1 standard. Then there's the 3-letter SLV for the 639-2 standard.
Got it.
And then, crucially, the highly specific locale code SLSI for Slovenia itself.
And if they miss one?
If those aren't hard-coded into the initial loading sequence, the software might format a date as month, day, year instead of day, month, year, or misplace a decimal comma, which immediately invalidates a legal financial document in Slovenia.
Wow, just from a comma. So those codes get the interface reading in Slovenian and formatting numbers correctly. But the real language the software needs to speak isn't linguistics, is it?
No, not at all.
Once the user interface is rendering correctly, how does the math engine actually know what financial rules to load?
That is where the primary accounting standards come in. And this is entirely dependent on the type and the size of the entity using the software.
Okay.
So in Slovenia, the primary national framework is called the Slovenian Accounting Standards, or SAS. If you are a micro or small entity, which, by the way, makes up the vast majority of businesses, you are legally required to use SAS.
Wait, there are no exceptions for the little guys? You can't just choose an international standard if you prefer it?
None. You have to use SAS. But if you flip to the other end of the spectrum and look at a public interest entity,
Cool.
think major banks, listed companies, or insurance firms, they are strictly required to use International Financial Reporting Standards, or IFRS. Yes, exactly as adopted by the European Union. And then you have the medium and large businesses sitting right in the middle.
What do they do?
Their default is to use the national SAS framework, but they are given the option to voluntarily choose IFRS if it better suits their international operations.
Okay, let's unpack this. So
Yeah.
it's almost like a financial dress code that the software has to automatically enforce.
I like that, yeah.
Like micro businesses have to wear the SAS uniform, no questions asked. The banks and public companies are wearing the strict IFRS tuxedo. And the medium businesses get to look in their closet every morning and choose between the two.
I love that analogy. And what's fascinating here is that Slovenia actually does not require the specific IFRS for SMEs standard at all.
Really?
Yeah, many countries adopt that lighter international standard for their small businesses just to make global trade easier, but Slovenia doesn't. They keep their entire small and medium ecosystem highly reliant on their own national SAS framework.
Why do they do that, though? Doesn't that sort of isolate them?
Not at all, because they've built a brilliant bridge. SAS is already perfectly harmonized with the broader EU accounting directives.
Oh, that makes sense.
Yeah, so it is a local language, but it translates perfectly to Brussels. For the developers building osFinancials, this means they have to hard code this SAS framework deeply into the default system architecture.
So it's baked in.
Right. It's not a plugin or a suggestion. It's the legal reality for their core user base.
Okay, so the software has forced the business into the right accounting standard based on its size. But wait, how does the software know if the business is actually a capital company or just like a guy working from his living room?
Good question.
Because surely those two don't pay the exact same taxes.
You are absolutely right. In the database, there has to be a strict Boolean flag separating an individual structure from a corporate legal entity. Let's look at the corporate side first.
Okay, let's do it.
If you form a limited liability company, a DOO, or a joint stock company, ADD, your business is totally decoupled from your personal finances. It is a completely separate legal sandbox.
Right. And what does that mean to the tax calculation engine?
The corporate entity pays a 22% corporate income tax, or CIT, on its net profits. And here is a detail that shows how real-world events literally change lines of code.
Well,
That 22% currently includes a temporary 3% surcharge specifically to fund flood reconstruction.
wow, really?
Yes, that surcharge is valid through 2028. So the software has to know to apply that 22% and then automatically schedule a logic update for 2029 when the surcharge expires.
That is wild.
It is. Furthermore, when that company pays out dividends to the individuals who own it, a 25% withholding tax is applied. So it's a strict two-tier taxation system.
Wait, hold on. What about partnerships? Because if I look at a partnership in the US or the UK, it's usually just a pass-through entity, right? Like the business itself doesn't pay income tax. The profits just pass through to the partner's personal tax returns. Does the software have to treat a Slovenian partnership differently?
Completely differently. Slovenian partnerships, like an unlimited liability company-ADNO, are treated as separate legal entities under the Corporate Income Tax Act.
Oh, wow.
Yeah, they pay that exact same 22% corporate tax on net profit. They are not pass-throughs.
Okay, so if the developer messes that up.
Right. If the developer builds a pass-through module for a DNO based on American logic, the user is going to get audited and fined instantly. The software must flag them as a corporation for tax purposes.
Okay, here's where it gets really interesting. Because if you aren't a corporate entity, if you're just an individual, a sole trader, known as an SP, right?
Yes, exactly.
The software has to offer you two radically different paths for your taxes. And one of them sounds like an absolute cheat code. So imagine you're a freelance developer sitting on your couch in Ljubljana. Walk us through these two paths.
Okay, for a sole trader, the first path is the actual expenses regime, or Dziękowatskie SP. This is standard, rigorous bookkeeping. You track your actual revenue, you deduct your actual documented costs like rent, software subscriptions, materials, and your net profit is taxed on the standard progressive personal income scale.
Which is how much?
For 2026, that scale starts at 16% and climbs all the way up to 50% for high earners.
Very standard. You make more, your percentage goes up.
Right.
But then you have the second path, the normalized expenses regime, known locally as the normorancy.
Right. Yes, exactly.
And under this path, you don't track your expenses at all.
Yeah.
The state just automatically grants you an 80% flat expense deduction on your revenue.
Yes. The software literally bypasses the expense ledger. If you make 100,000 euros, the government simply pretends that you spent 80,000 euros to make it, regardless of whether you actually did.
That's insane.
Yeah.
And then you are only taxed on that remaining 20% of your revenue.
Correct.
And the tax rate on that remaining chunk is a flat 20%. So wait, 20% of 20%.
Yeah.
That means your effective tax rate is roughly just 4% of your total revenue.
Exactly. 4%.
If I am that freelance software developer working from my couch and I have basically zero overhead,
Yeah.
I keep 96% of what I make.
You do.
So my question to you is, why on earth wouldn't every single sole trader choose the 4% effective tax rate?
Right.
Like, why do developers even bother building the actual expenses module in the software if everyone is just going to pick the cheat code?
Well, because the government is well aware of how advantageous it is, so they built strict guardrails that the software must actively police.
Oh, I see.
Yeah, the software doesn't just cheerfully calculate the 4%, it acts as a gatekeeper.
Hmm.
For a full-time sole trader, that magical 80% deduction is only valid on revenues up to 72,000 euros.
Okay, so there's a cap.
Yes. And if you are a part-time sole trader, meaning you have a full-time job elsewhere and do this on the side, the cap is strictly 33,000 euros.
Got it. And what happens if you go over?
If your revenue crosses those caps, the software has to instantly trigger a much higher 35% tax rate on the excess.
So the database have to constantly monitor your invoicing to see if you took the wire. You can't just run a $1 million consulting firm at a 4% tax rate.
Exactly. But there's an even bigger trapdoor that the developers have to architect.
With that.
Let's say you start as a normoranci enjoying that flat rate, but then your business booms. You need to hire employees, lease an office, your actual overhead skyrockets.
Right.
At that point, you decide to exit the normalized system to track your actual massive expenses. If you do that, you are legally locked out from re-entering the normalized system for 5 full years.
Wow. A 5-year penalty box.
Yes.
Think about what that means for the database. The software can't just calculate today's taxes based on today's settings. It has to retain a permanent, unerasable memory of your legal status from half a decade ago.
Exactly. It requires a historical status table in the database tied directly to your national tax ID. It has to hard lock the user interface, literally graying out the normalized option, so a user in the penalty box physically cannot select it.
That is so strict.
It is.
Yeah.
You cannot just flip-flop back and forth every year, depending on what saves you the most money. And there's one more crucial threshold the software must calculate for these structures, which is the 2026 social cap.
Ah, right, because Social Security contributions in Slovenia are notoriously heavy, right?
Yeah.
We are talking roughly 38.2% of gross labor allocations when you combine the employer and employee sides.
It is a massive burden, yes.
Yeah.
But to prevent a brain drain of top-tier technical and managerial talent leaving for cheaper tax jurisdictions, Slovenia implements a social nakapika, a social cap.
Okay.
The maximum monthly base for calculating all Social Security contributions is strictly capped at 7,500 euros.
So what does the software do when a user hits that number?
It has to hit that ceiling and immediately execute a kill switch on the contribution math. Any salary or entrepreneurial base exceeding 7,500 euros per month is entirely exempt from further social contributions. The database ensures the tax burden doesn't expand linearly to infinity.
That is a brilliant mechanism to keep high earners in the country.
It really is.
Now, let's pivot a bit. If a user is running a massive corporate entity, or if they are a sole trader who has outgrown the 4% hack and is tracking all their actual expenses, where does the software actually store the daily transactions?
That's the core of it.
Because looking at this roadmap, Slovenia leaves absolutely nothing to the imagination.
No, they do not. If we connect this to the bigger picture, the entire goal of the Slovenian tax authority is absolute unyielding standardization.
Right.
They don't want 1,000 different accountants using 1,000 different naming conventions for office supplies. So for any small or medium enterprise using double entry bookkeeping under those SAS standards we talked about, they must use the recommended uniform chart of accounts.
This is the 10-class decimal system, right? Classes 0 through 9.
Yes.
And the developer roadmap lays out exactly how this has to be built into the database architecture. But why a decimal system, though? Why not just let people name their folders whatever they want?
Well, because relational databases love integers. A 0 through 9 decimal system means a computer algorithm can parse 1 million transactions in a fraction of a second just by looking at the leading digit of an account code.
Oh, that makes sense.
Yeah. If the first digit is a Huan, the software instantly knows it's a short-term asset. It doesn't have to read text or interpret a user's spelling.
I see. So it's designed for machine reading from the ground up.
Yeah.
Walk us through how this grid actually works in the software.
It's a very logical progression. It starts with the balance sheet. Class 0 and Class 1 are your long-term and short-term assets.
Okay.
Class 0 is for the heavy, immovable things, buildings, heavy machinery, long-term investments.
Mm-hmm.
Class 1 is for the highly liquid things, like cash sitting in the bank or short-term receivables from clients. Then Class 2 handles your short-term liabilities, so the money you owe right now to suppliers or the government.
Okay, so classes 0, 1, and 2 give the software everything it needs to generate a balance sheet on demand. Where do the day-to-day operations go?
That moves us right into the inventory and expense classes.
Yeah, and I noticed an amazing detail in the roadmap about this. Classes 3 and 6 smartly separate physical goods based on their state of completion.
Yes, they do.
Like, Class 3 is strictly for the inventory of raw materials, and Class 6 is for the inventory of finished goods and merchandise. So if you are running a bakery, the software forces you to put the bags of flour and sugar in the back into Class 3, and the fully baked bread sitting in the retail display case into Class 6.
Precisely. It cleanly isolates the manufacturing inputs from the retail outputs. This allows the software to instantly calculate the value added during production.
That's really smart.
It is. Then you have Class 4, which captures all your operational expenses by nature, chronologically. Rent, salaries, the electricity bill. It all flows into Class 4.
But then I look at Class 5 in the roadmap, and it's completely blank.
Yes.
It's officially called the free class. Why would a rigidly standardized government framework just leave an entire decimal class empty?
It's an intentional sandbox.
Like
The government knows that businesses need internal analytics that have nothing to do with taxes.
Oh, okay.
So under the mandatory rules, companies use Class 5 to optionally clear costs out of Class 4 and allocate them into internal management cost centers.
Give me an example.
Well, say you want to build a custom report to see if your marketing department in Ljubljana is burning more cash than your engineering department in Maribor. You build that in Class 5.
Oh, I love that. It's like the government rigidly zoned an entire city grid for you. They told the developers exactly where the houses go, where the factories go, where the roads are. But they left one empty park in the middle of the city Class 5 and said, here, your software can build whatever internal management reporting structures it wants. Have fun.
That is exactly the logic. But if a small business doesn't need that level of granular internal tracking, they just skip Class 5 entirely.
Makes sense.
To finish the grid, Class 7 handles your operating revenues. So, the money coming in from sales. Class 8 is the clearing account where the software mathematically matches your revenues and expenses at the end of the year to find your profit or loss. And finally, Class 9 wraps it up with your equity, your share capital, and your long-term liabilities.
So every single financial transaction in the entire country has to fit perfectly into one of these 10 buckets.
They must. And the reason they must brings us to the ultimate function of the software, and the reason those massive fines exist.
The VAT.
Yes, the value-added tax, the DDV. The software must take specific sub-accounts from this 10-class system and map them directly via an API payload to specific boxes on the national DDVO tax return.
I'm looking at the VAT mapping rules here. We're dealing with two main VAT rates. The standard rate is 22%, which hits most goods and services. And then there's a reduced rate of 9.5% for essentials like food, pharmaceuticals, and books.
Correct.
How does the database actually connect a sale to the government form?
When a business makes a sale, the software's math engine calculates that 22% or 9.5% output VAT and drops it into a very specific sub-account in Class 2, short-term liabilities.
Because you owe it to the government.
Exactly. You technically owe that tax money to the state, you are just holding it. Conversely, when a business buys a supply, it calculates the deductible input VAT and drops it into a specific account in Class 1 short-term assets because the government effectively owes that deduction back to you.
So what does this all mean? For the user running their business and for the software developer building osFinancials, why go through the monumental trouble of mapping every single Class 1 and Class 2 ledger entry directly to a government form? Why not just let the accountant figure it out at the end of the year?
Because the software is no longer just a digital calculator. It is a direct digital pipeline to the state. Slovenia operates a highly modernized tax environment using an online portal called idavki, and they enforce a system known as the pre-filled rule.
This completely blew my mind when I read it in the sources.
Yeah.
Walk us through how this data pipeline actually works.
It changes the entire paradigm of what accounting software is.
Right.
Under the old system, a business got to the end of the month, added up all their numbers, filled out a tax return, and sent it in.
Standard stuff.
Right. But under the idavki system, the software itself has to generate the raw transactional ledgers in a specific XML format. These are known as the KIR, which is your sales ledger, and the KPR, which is your purchase ledger.
And the timing of this is the crazy part.
Yes. The software must automatically upload these detailed, line-by-line KPR and KIR ledgers directly to the government portal at least 3 working days before the actual tax deadline.
So the government gets all your raw data early?
They get everything. And then the government's algorithms read your ledgers and they automatically generate a pre-filled tax return for you.
Wow.
The state does the math based on your data. The accountant's job is no longer to do the math. Their job is simply to log in, review the auto-populated boxes, check for discrepancies, and hit sign off.
The software feeds the government the raw materials, and the government tells you what you owe. You don't tell them.
Precisely.
But if your software developer mapped a code wrong, like if they accidentally sent a Class 4 expense into a Class 1 VAT asset bucket, the government's algorithm generates a completely clawed tax return.
Exactly. And the algorithm won't catch the nuance. It will just process the error. And the user is the one who faces the penalties, which range from 2,000 euros all the way up to 125,000 euros for major structural errors.
That's terrifying.
The developer's translation of these rules into database architecture has to be absolutely flawless. It has to be airtight.
Let's recap the journey we just took, because this was incredibly dense, but so illuminating. We started with the basic developer language codes, the SAL and SLSI, required to even boot the interface up properly without breaking the formatting.
Yeah.
We navigated the insane difference between the 4% normalized tax hack for sole traders and the rigid 22% corporate tax structure, and saw how the database has to remember a 5-year penalty box.
Which is still wild to think about.
And we explored that strictly mathematical 0 through 9 ledger architecture that makes Slovenian accounting actually function as a machine-readable system.
And it all culminates in that pre-filled IDAFKI pipeline, which, frankly, is where the financial technology industry as a whole is heading globally.
It is. The days of doing things on paper are long gone.
And this raises an important question, something we should all be thinking about. With systems like IDAFKI demanding raw transactional ledgers 3 days early to generate these pre-filled returns, the role of a human accountant is radically shifting.
Definitely.
They are moving away from data entry, and they are becoming data auditors. As governments increasingly rely on their own algorithms to write the first draft of a company's taxes, based purely on automated software uploads, how will ERP systems like osFinancials need to evolve?
That's the million-dollar question.
They won't just be calculating taxes anymore. They will need to be designed with robust, predictive AI to actively protect users from automated government errors before the upload even happens.
That is a wild thought. The software is a proactive defense mechanism against a bad government algorithm. It really brings us right back to where we started. You aren't just translating a word from English to Slovenian. You are translating the entire legal and financial reality of a nation into code. You are building the digital armor a business wears when it talks to the state. We want to thank you for joining us on this deep dive. Keep questioning the systems around you, and we'll catch you on the next one.